Mastering money and mind with macroeconomic factors shaping Bitcoin. Welcome back to Simple Mindspace, your haven for navigating the intricate worlds of finance and personal growth. Today, we're diving headfirst into the thrilling, often turbulent waters of Bitcoin, specifically exploring how the colossal waves of macroeconomic factors impact its journey. Buckle up, listeners, as we unravel the complexities of inflation, interest rates, regulations, and more, equipping you with the knowledge to make informed decisions in this dynamic landscape. Bitcoin and the inflationary tide. Imagine your money slowly losing its purchasing power, like sand slipping through your fingers. That's the insidious nature of inflation, the silent thief that erodes the value of traditional currencies over time. As prices for everyday goods and services creep higher, the purchasing power of your hard-earned cash diminishes. This economic reality pushes savvy investors to seek refuge in assets that can weather the inflationary storm and retain their value. And Bitcoin, with its finite supply of 21 million coins, has emerged as a beacon of hope. Let's take a trip down memory lane to 2010. Back then, a Bitcoin enthusiast famously used 10,000 Bitcoins to buy 2 pizzas. Now, imagine trying to buy those same 2 pizzas with the same amount of Bitcoin today. The sheer difference in value is staggering. This example, albeit extreme, perfectly illustrates Bitcoin's potential as a hedge against inflation. Think of countries like Venezuela, ravaged by hyperinflation, where their local currency, the bolivar, has plummeted to almost negligible value. In such dire economic situations, Bitcoin has provided a lifeline, a store of value that allows individuals to protect their wealth from the relentless devaluation of their national currency. It's not just about hypothetical scenarios either. We've seen real-world evidence of Bitcoin acting as a safe haven. During the recent global surge in inflation, fueled by factors like supply chain disruptions and expansive monetary policies, Bitcoin's price experienced significant upward momentum as investors sought shelter from the storm. However, it's crucial to remember that Bitcoin's journey is not a smooth upward trajectory. Its price can be volatile, influenced by a multitude of factors beyond just inflation. This volatility underscores the importance of thorough research, risk assessment, and potentially diversifying your portfolio, even when considering assets like Bitcoin. Navigating economic recessions. Is Bitcoin a safe harbor? Economic recessions, like dark clouds on the horizon, can cast a shadow of uncertainty over global markets. Traditional assets, such as stocks and real estate, often bear the brunt of these downturns, their values plummeting as consumer spending and investment dwindle. Yet, amidst this economic turbulence, Bitcoin, the decentralized maverick, often dances to a different tune. Think back to the early days of the COVID-19 pandemic. In March 2020, as fear gripped the world and markets crashed, Bitcoin initially mirrored the downward spiral. But then, something remarkable happened. Bitcoin rebounded with a vengeance, defying expectations and reaching new all-time highs by the end of 2020. This resilience showcased Bitcoin's potential as a safe haven asset, capable of weathering the storm even when traditional markets faltered. Why this resilience? Unlike traditional assets tethered to specific economies or governmental policies, Bitcoin operates on a decentralized network, free from the shackles of central bank control or geopolitical turmoil. This independence gives it an inherent hedge against traditional market instability, making it an attractive option for investors seeking to diversify their portfolios and potentially mitigate risk during economic uncertainty. However, remember that past performance is not indicative of future results. While Bitcoin has shown resilience during certain economic downturns, it's not immune to the forces of a global recession. Its value can still fluctuate based on market sentiment and investor behavior, highlighting the importance of approaching any investment, even one as promising as Bitcoin, with a healthy dose of caution and a long-term perspective. The interest rate dance, how central banks influence Bitcoin's rhythm. Central banks, those enigmatic institutions wielding immense economic power, play a pivotal role in shaping global financial landscapes. Through their ability to manipulate interest rates, they can either stimulate economic growth or rein in inflation, with significant implications for assets across the board, including Bitcoin. Lower interest rates are like a siren song for borrowers. making it cheaper to access capital and fueling investment and spending. This often creates a risk-on environment where investors feel emboldened to explore assets with higher potential returns, even those with higher risk profiles, such as Bitcoin. Conversely, when central banks raise interest rates, they effectively increase the cost of borrowing, aiming to cool down an overheating economy or combat inflation. This shift often leads to a risk-off environment, prompting investors to retreat from riskier assets like Bitcoin and seek shelter in the perceived safety of traditional interest-bearing assets like bonds. For instance, in 2020 and 2021, as the global economy grappled with the COVID-19 pandemic, central banks worldwide, including the powerful US Federal Reserve, slashed interest rates to near zero levels and implemented massive stimulus packages. This flood of cheap money fueled a surge in asset prices across the board, with Bitcoin riding the wave to new heights. However, as inflation reared its head in 2022, central banks reversed course, embarking on aggressive interest rate hikes to combat rising prices. This shift in monetary policy put downward pressure on Bitcoin and other risk assets as investors sought safer havens. Understanding the intricate relationship between interest rates and Bitcoin's price movements is crucial for navigating the market effectively. By closely monitoring central bank announcements and policy changes, you can anticipate potential shifts in investor sentiment and adjust your investment strategy accordingly, whether that means riding the wave of a risk-on environment or seeking shelter during a risk-off period. Navigating the regulatory labyrinth, how governments shape Bitcoin's destiny. Governments, with their power to enact and enforce regulations, wield significant influence over the adoption and acceptance of emerging technologies like Bitcoin. Countries that embrace innovation and establish clear, supportive regulatory frameworks for cryptocurrencies often witness greater adoption rates and more stable Bitcoin markets. In contrast, nations that impose stringent restrictions or outright bans risk stifling innovation and creating uncertainty, hindering Bitcoin's growth. A prime example is the stark contrast between Switzerland's welcoming approach and China's crackdown on Bitcoin. Switzerland, a global financial hub known for its progressive stance, has implemented a clear and supportive regulatory environment for cryptocurrencies. This clarity has attracted businesses and individuals involved in the crypto space, solidifying Switzerland's position as a global leader in blockchain and cryptocurrency adoption. On the other hand, China, once a dominant force in the Bitcoin mining industry, implemented a series of stringent restrictions, culminating in a complete ban on cryptocurrency transactions in 2021. This move sent shockwaves through the crypto market, causing significant price volatility and forcing mining operations to relocate to more hospitable jurisdictions. The regulatory landscape for Bitcoin remains fluid, with governments worldwide grappling to find the right balance between fostering innovation and protecting investors. This ongoing evolution underscores the importance of staying informed about regulatory changes in the countries where you invest or trade Bitcoin. Keep a close eye on news and announcements from regulatory bodies and seek guidance from financial advisors to ensure you're operating within the legal framework and mitigating potential risks. Charting Bitcoin's course, a glimpse into the future. Looking ahead, Bitcoin's journey promises to be as exciting and unpredictable as ever, shaped by a confluence of macroeconomic forces, technological advancements, and evolving investor sentiment. Despite its inherent volatility, many analysts remain cautiously optimistic about Bitcoin's long-term prospects, citing several key factors. The Bitcoin halving event. Every 4 years, the rate at which new Bitcoins are created through a process known as mining is cut in half. This event, known as the halving, effectively reduces the supply of new Bitcoins entering the market. With demand remaining relatively constant or even increasing, this supply squeeze could potentially drive up Bitcoin's price. The next halving event is predicted to occur in 2024, and many analysts are eagerly watching its potential impact on the market. Growing institutional adoption. What was once considered a fringe asset is gaining increasing acceptance from institutional investors, including hedge funds, asset management firms, and even publicly traded companies. This growing institutional interest lends legitimacy to Bitcoin as an investable asset class and injects significant capital into the market, potentially driving further price appreciation. Decentralized finance (DeFi) revolution. Bitcoin, while often viewed primarily as a store of value, is increasingly being integrated into the burgeoning world of decentralized finance (DeFi). DeFi applications built on blockchain technology offer a wide range of financial services, from lending and borrowing to trading and insurance, without the need for traditional financial intermediaries. As DeFi continues to evolve and gain mainstream adoption, Bitcoin's role within this ecosystem could expand, potentially driving further demand and value. However, it's crucial to acknowledge the potential headwinds that Bitcoin may face. Regulatory uncertainty. As discussed earlier, the regulatory landscape for Bitcoin remains in flux, with governments worldwide still grappling to establish clear guidelines. Unexpected regulatory changes or crackdowns could create significant volatility and hinder Bitcoin's growth. Competition from altcoins. The cryptocurrency space is constantly evolving, with new altcoins and blockchain projects emerging regularly. While Bitcoin remains the dominant cryptocurrency by market capitalization, it faces competition from newer entrants offering innovative features or addressing specific use cases. This competition could potentially erode Bitcoin's market share and impact its price. Volatility and market manipulation. Bitcoin's price remains highly volatile, subject to rapid fluctuations driven by factors ranging from news events and regulatory announcements to investor sentiment and even market manipulation. This volatility can create significant risks for investors, especially those with a short-term investment horizon. Navigating the Bitcoin market requires a balanced approach, combining cautious optimism about its long-term potential with a healthy awareness of the risks involved. Thorough research, diversification, and a long-term investment horizon remain crucial for successfully navigating this exciting yet unpredictable asset class. Mastering your financial destiny in a world of change. As we conclude our deep dive into the fascinating interplay between Bitcoin and macroeconomic forces, let's recap the key takeaways to empower you on your financial journey. Inflation hedge. Bitcoin, with its finite supply, has emerged as a potential hedge against inflation, especially during periods of significant currency devaluation. Economic uncertainty. Bitcoin's decentralized nature has shown resilience during economic downturns, making it an attractive option for portfolio diversification. Interest rate sensitivity. Bitcoin's price can be influenced by central bank policies, with lower interest rates potentially boosting demand and higher rates leading to a shift towards safer assets. Regulatory landscape. Government regulations play a crucial role in shaping Bitcoin's adoption and acceptance, with clear, supportive frameworks fostering growth and restrictive measures hindering it. Future outlook. While Bitcoin faces potential challenges like regulatory uncertainty and competition from altcoins, its long-term prospects remain promising, driven by factors like the halving event, institutional adoption, and the rise of DeFi. The world of finance, much like life itself, is in a constant state of flux. By staying informed, embracing continuous learning, and adopting a long-term perspective, you can navigate the ever-changing landscape with confidence and work towards achieving your financial goals. Remember, the journey to mastering your money and mind is an ongoing process, and we're here to guide you every step of the way. Until next time, keep exploring, keep learning, and keep striving for financial empowerment. If you found today's deep dive into Bitcoin and macroeconomic factors insightful, don't forget to like, share, and subscribe to Simple Mind Space for more empowering content on finance and personal growth. Until next time, stay curious, stay informed, and keep striving for a brighter financial future.